Calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
Hey, welcome back, Market Rebels and all of our YouTubers out there. It's that time again, Thursday, 4 p.m., right on the closing bell. We do this every Thursday with Coach's Corner, and what a wild ride today, huh, Stu?
Oh, yeah, up and down and up and down and up.
But that's what we live for. I think the SPY was down almost 2%. I checked it maybe 15, 20 minutes ago, and I think you said looked like a little rally going down about maybe 1.3% into the close.
Yeah, towards the end, looks like we closed down about 1.4%. The market definitely picked up starting around, I don't know, let's see, maybe 2 o'clock or so.
Yeah. So it looked like we threatened the 50 yesterday, so I thought we were hopefully going to pop through it and failed it. So hopefully we're making tracks back up there. We're on our way. Today we have another special guest with us, appearing for the first time, another one of our full-time coaches, Scott Thorstenson, who was previously with TD Ameritrade and Thinkorswim. Scotty, welcome.
It's good to be here. Thanks for having me, Bill.
Yay, we love Scott.
He's always got just great things to say. We learn stuff from Scott. I learn stuff from, we really do. All of us learn from each other, and we know that we have lots that we can teach everybody else out there. And that's really what this is about, to bring you the perspectives of professional market makers, traders, coaches. Stu, as everybody knows, was 29 years on the Philadelphia Stock Exchange as a market maker and specialist. Lots and lots of things that we can teach you.
Made it out alive.
And he did, although your hat kind of tells a different story.
There was days when I didn't think I'd make it out alive.
So anyway, as we talked about last time, we have a new segment that we're going to do, little questions here for Chalk Talk, our little coaches Talk corner. So today, what I want you to do is to jot down your answer. Now, I know there's not a lot of information here, and we could make arguments that all kinds of things. But based on the information, let's say that you have the opportunity to pay 2 to make 8. Maybe these are vertical spreads, let's say. And another way you could pay 8 to make 2. And the question that we have for you is, which would you choose and why? And we want you to just think about that. It's going to be related to our topics today. So actually, I want to see both you, Scotty and Stu.
I know my answer already.
You did? All right, good. We're going to come in.
I got it. I'm not going to show it to you, but here's the piece of paper, but the answer's on the other side.
You're going to have a chance at the end, so we'll come back and revisit that in just a little bit.
And I want everybody watching to write it, commit, write the answer down.
It's very powerful because otherwise people always say, oh yeah, I would have guessed that.
Yeah.
We want you, it's super easy to convince yourself you would have got it right. Pick an answer, and that way you know that you learned something.
It's like running a marathon. It's just kind of nonsense until you actually write the check to get into the race.
That's right.
Now you're committed.
So today we're going to talk about a really common topic that we get among traders, and I know you guys get it a lot as coaches, but should you trade for percentages or dollars? This is really an age-old question. I know he's laughing about it already. From traders, because they'll say, and you can always tell the traders that are leaning in that direction, they'll say, oh, well, I'm up 30% this week, or I made 70% on my options trade last year or last month. They're always reporting the percentages. But remember, that means you could have bought one option at $1 and sold it for $1.70. And so you put $70 into your pocket. Was it really worthwhile? Are you making real money? Is your goal to make percentages, which don't really pay anything? Go try to buy a car and say, I'd like to give you some of my percentages. They're not currency.
Yeah, see if you could pay the electric bill with
pay the electric bill with your percentages, right? They want dollars.
It's not going to work.
So the thing that we usually lean towards, or at least want to give people a different perspective on, is to at least consider the dollar side. What's your goal? How many dollars did you start with? What are you trying to do? Are you trying to get to a certain level at the end of the year? Or are you trying to just boast about the percentages? So let's go ahead and take a look at the first point that I wanted to make. Again, remember that percentages are not money. If you have $100 that grows to $200, yeah, you made $100 and you made 100%. It looks great on paper. But what if you had $1 million that grows to 1.2 million? That's $200,000, even though it's quote unquote only 20%. So you have to say, which would you rather have? Boast about the 100%? Or say, well, I only got 20%, but it was on the entire portfolio. Because
is this where we vote? Do I vote here? Is this where you vote? No,
not now.
Okay.
But this is where a lot of people have troubles, because they say, I've got maybe $1 million portfolio, and they're messing around with these little dollar options or 5 contracts, paying $1 for them and selling them for $1.50 and going, oh, I made 50% on my money. Yeah, but look at what it did for your entire portfolio. It's a big fat zero. It did nothing, and yet you're sitting here spending all of this time and energy for no dollars. So we just want to make sure that people are aware and are setting up their portfolios and their goals with dollars in mind. So again, are you trying to invest for percentages or dollars? So take a look at this. Here is $10,000. And the blue line is 10% over 20 years. That'll grow to 67,000. 15% would grow to 163, and 20% would go to $383,000. And even though these percentages might look low, especially for some options traders, because they're used to hearing 70s and 100s and 200 and 300, but are they doing it consistently month after month? Well, that can't be true.
Year.
And year after year, that's not what the markets return. So one of the things that we want...
Bill, what do the markets return?
Well, typically 8%, maybe long-term, 6%, 8, 10.
That's it. That's right.
Yeah, sure. We can get 20%, 30 or 40% in a year. We've been down minus 40%, but those are extremes. And yes, you can get some leverage from the options, but we're just trying to give people a different perspective to maybe use the options to hedge the unwanted risks, maybe add a little leverage for the risks that you do want to take, and let's grow the dollars. So now let's take these same numbers with $100. Same trader does $100 for 20 years, 10, 15, and 20%. I mean, look at this. That's $3,800. After
Which
inflation,
is nothing to sneeze about, but you're not retiring on it.
Well, after 20 years, it kind of is something to sneeze at. I mean, you're going, and after inflation, you're going, was it really worth all of that time? And this is the problem when people solely focus on percentages. Now, don't get me wrong. There are certainly times where percentages count. But we hear too many times where traders just focus on percentages, and they're picking their strategies just because of the percentage returns. And usually what that does, it makes them reach for very cheap options that they can pay 30 cents for. And if I can sell it for 35 cents, look at the percentage return that I got. And you're going, well, yeah, but there's no money in it. So the first question I want to throw out to both of you, and I'm going to start out with Scotty since he's our special guest today. Do you focus on percentages or dollars, or what do you teach your clients?
Well, ultimately, the name of the game is dollars, right? We want to grow our account, and dollars are most important. We traditionally measure performance based on percentages, but at the same time, I think it's important to consider both. And we're not looking for big returns. We love to celebrate big home run trades, 100%, 80% wins, but that may be a win on a small amount of money, and that doesn't go a long way, like you demonstrated. So it is important in knowing how to use your capital and use your portfolio in a way to really reach the end goal, which is to grow your account. We want to focus on the dollars and use strategies that can benefit from growing the account.
Absolutely. So yeah, those are things that I'll look at and say, well, maybe we can invest a smaller percentage of the account by using the options or doing stock replacement strategies and still get to that same goal with fewer dollars. So there are times that we want to look at percentages as a measuring stick, but my main point is that too many times we hear that traders just focus on strategies all about percentages, that they just want to buy these super cheap options and flip them for 30, 40 cents because they're making 40 and 50, 60% on them. So Stu, how about you? What do you teach your clients?
Look, I always I have to focus on the dollars. You have to focus on the outcome. I always say, are you looking at percentages or are you looking at outcomes? I'm looking at outcomes. But again, it doesn't mean that I'm not looking at percentages as well. You just have to keep it in perspective. If you make 100% on the trade, you made $100, then you made 100%. But so what? It's just chatter for the dinner table. It doesn't mean anything. When you look at your overall portfolio, the $100 on 50 grand or 100 grand or bigger money,
minuscule.
It doesn't even begin to think about moving the needle. So you gotta like really focus on the outcomes. What are you doing? You want to try and be efficient, and you're trying to get from point A to point B, and you're trying to make the most money while you're taking the least amount of risk that you can. And the more you slide into the more risky trades, the more you become the speculator, the gambler. And you have to keep it all in perspective. Yeah, it's good to say, hey, I want to make 10% a year. There's nothing wrong with that. That's good. That's a goal.
On the entire portfolio.
On the entire portfolio. That's a goal, and that's great. That's a great place to start to develop strategy. But to say, hey, I made 80% on that trade, next. I don't care. Doesn't mean anything.
Right. Because if you can't repeat it, you have to say, all right, yeah, you got 80% this time, but how many are going to be 100% losers before that next 80% comes in? And when you start looking at it from that perspective, it can be quite high. So quick little...
And you know what? Let me say one more thing. That percentage number, whatever that is, whatever you think is great, 30, 40, 50, 60, 70, 80%, listen, that number is... It could be light. It could be heavy. You have to trade. If you're going to trade, not invest, but if you're going to trade, trade the price action, trade the movement, trade the stock, trade the resistances, use oscillators, use a few studies to help you kind of pinpoint places to make it. Well, I'm starting to get into another topic, but to do something. Maybe that 80% really was 150% or 160%. And you left that money on the table. In fact, I get it all the time. Man, I exited too early. Well, that's what we're here to help you guys with. We're here to help you. We're here to help you manipulate the trade, to extract ways to handle diversification of risk, to identification of risk, to diversify it out.
And that's exactly right. It's always about getting a different perspective and understand how professional traders are able to move money through time by managing risk. So for anybody who'd like to learn more, get educated, there's over 40 courses, marketrebellion.com/get started. So a lot of times this whole concept of grabbing these little tiny trades for pennies, on the floor, Stu. I know they used to have an expression about picking up nickels in front of bulldozers. What was the one you told me the other day? It was actually quite funny.
Chasing the trash truck.
Chasing the trash truck. Same idea. You're sitting here going, I'm running out here in the middle of I-95 and grabbing all of these nickels and going, but look at what a great percentage it is. Because I started with 0 and I picked up 5 cents. Look at what a great percentage that is.
Yeah, well, look, I sold this spread for a nickel and it went to 0 and it went out worthless and I made 100%. Are you kidding me?
Right.
You moron.
They don't consider the risks that they took. So one thing that I like to show is that there's a bell curve. Remember, for every current stock price, there's an implied bell curve over its head. To the right are the gains in green and to the left are the losses in red. So if you are a trader that says, I'm going to intentionally clip this trade for a small amount of profit, buying the option for $1 and selling it for $1.50 or something, look at what the perspective is. You are intentionally chopping the right side off, and yet you will always have 100% of the downside, no matter what you think you're doing. If you are in the trade, you have 100% of the downside. And for people who don't think that's true, you haven't been trading long enough until you see things. I remember back in the day, Emulex was a big one that halted intraday and gapped down something like 70 points once it opened. There's nothing you could do. So
that list of names kind of goes on forever.
Forever.
It's going to be that situation. The goose eggs go up. Listen, it's always going to happen. And listen, you got to come to work tomorrow, right? You have to be able to come to work tomorrow. You make too many dumb mistakes before you know it, you're down 80% or 100% or you're minus equity. And hey, now what are you going to do? Find something else to do.
Yeah, there's a word for this slide, right? Scalping, putting a lot at risk to gain a small amount.
That's exactly what it is.
That may work in a certain situation, but over time doesn't always play out in your favor.
That is correct.
Hard to repeat that on an ongoing basis and be profitable in the end.
Right.
You have to be able to do like Bill's talking about here. You have to, this is an interesting graphic. You really have to be able to, well, go ahead, Bill, keep going.
No, that's exactly right.
You have to be able to move these lines to gain advantage.
Right. That's what I wanted to show here is you have to move this line out to the right so that you can stay in the trade. Scotty was talking about scalping. That is a trading style, but it's more for market makers back in the day because they were paying 0 commissions. They had a seat on the exchange. They're standing around building portfolios. They had no other choices. They'd be among the first to see the information coming in. So sure, it's a whole different ball of wax at that level. But for the average retail trader to go up there and say, I don't know, let me pick up this option for $1 and I'm going to close it when it gets to $1.30. Why? Because look at how much I made. And then in percentage terms. And then what they always do is annualize it. Yeah, it was 30% in a month, but it was 360% over a year. It's still $30. You have to keep that in perspective. So next question, Scotty, let's throw it back over to you. What are some things that you do to kind of move this line in this bell curve to the right? What do you teach your clients?
Well, if your loss is $5 and you're trying to capture $1 or $500 capturing $100, that average loss compared to the average expected gain is unfavorable. So ways that we go about increasing our average gain, increasing our potential reward is to roll options when you have a profit, when stock's moving in our expected direction. We want to roll those profits and increase our reward, try to capture a greater reward. We can also limit risk by setting stops, by using a vertical spread to define our risk, by selling another option against the long option. Yep. That's a great way to define the risk, lower the risk, and pushes our potential reward greater.
Or leg into the spreads at future dates, maybe after a roll. All kinds of things to do. Yeah. Stu, how about you?
You have to start out by defining the risk. It always helps to quantify your numbers.
And how do we do that? You got to have a goal.
You got to have a goal. You can't create a strategy without a goal. Right. Once you create a goal, you can create a strategy to help you attain that goal. Correct. And as option risk managers, because that's what we are, that's what the job description says. You have to say, if I put a trade on, what can I lose? The concentration has to be on the loss side. It has to be, what can I lose? It has to be quantified. It's not, well, that's never going to happen because, it will. So you have to just say, where's the risk? Is it the Vega risk? Is it the Delta risk? What kind of risk is it? And manage it to an extent that makes it acceptable to you, the trader, in the event that it doesn't go your way. And that's on the left side of that curve. You can adjust that peak by quantifying your numbers and making them accessible. On the right side of that graph is being able to push that out by, Scotty said one of them, rolling. If you buy something for 4 and you sell it for 4.5, yeah, are you rolling? Yeah, but are you managing the risk? No. You have to. The point of the roll is to capture money. Capturing 50 cents is not really capturing money. Right. Trim. I always tell people trim. Right. If you're doing more than one, trim, roll. Use a delta magnifier to help you see the reduction or the diversification of the risk off the table into your pocket, and that always helps as well.
Yep, and sell half, roll half is another one. You hear John and Pete talk about that.
That's the trim, right? So if I have 2, I'll sell 1 and I'll roll the balance. If I have 5, when I get to a level, which is, by the way, it's predetermined what that level is.
Yes.
It's not, I'll see where it is when I get there. This is where it is before I even hit the enter button to go into the trade.
Part of the goal.
That's planning the trade, and the execution of the trade is trading the plan. And you can't do one without the other, and you shouldn't do any trade if you don't have the whole big picture put together for each and every trade.
Yeah. And that's one of the things I like to show traders is that we have found that most people don't have that perspective. They're too hung up on bought the option for $1 and I sold it for $1.50. And yet they've got a $500,000 portfolio and they're spending all of this time and it's just not any money. Again, yes, of course, there are times that can make sense, but it shouldn't be your primary driver. Now,
how about the other side, Bill? How about when they bought them for $1 and it goes, and they didn't get the timing specifically correct because they didn't read the chapter that said, I can't pick the top and I can't pick the bottom. And it goes to 90 cents and they're bailing. Really?
And they're bailing, right.
Are you kidding me? You didn't set up a range?
That doesn't mean you're wrong. Just
doesn't mean you're wrong. Doesn't mean you're wrong at all. No,
but then they'll say, I'm down 10%. I got to close it.
You got to define the sandbox that you're willing to play in.
That is exactly right. That's a very good risk management tool. And again, perspectives that most people don't have.
I might write a book. Can I call it Define the Sandbox?
I like that idea.
I like that. The
sandbox you play in. So here's another topic here that I hear a lot of traders talk about. And they always say, well, I'm reaching for these percentages and I might have a slightly higher winning percentage than my losing percentage. That's why I want to try to cut these losses. But here's where things can really backfire. So take a look at this. Let's say that you have a 50% chance of winning 30%. That's this top row here in green.
Big
and you
win.
have a big win. You get a 50% chance of losing 25%. Now, if you were able to do this.
50-50, I like that.
Yeah, if you could do this over and over, you would have, technically speaking, a positive 2.5% in your favor, which Vegas,
I know where this is going, but
Vegas wouldn't even sneeze at that, except in this case, they would.
Time out for 1 second here. So folks, what you need to be able to see is, I'm just going to say, and I haven't seen it, the next slide. You have to be able to see where this is going to understand the process of this compounding, of the money moving up, of the money moving down. So go ahead, take it, Bill.
Yep, that's beautifully said. It's sort of the problem that we see with the levered ETFs. So even though theoretically you have a mathematical edge in your favor, what's really happening is you're coming up with infinitesimally small probabilities of winning all the money in the world. But what's most likely to happen, check this out. We're going to run this simulation here 500 times in Excel. Whoa. Did really well, and then what happened? In the long run, bottomed out. Was that a fluke? Let's do it again. Had some pretty good runs. In the long run, bottomed out. We do it again. What happens? In the long run, we bottom out. Now, how can that be if we have a an apparent edge in our favor. Well, take a look. The errors are compounding. Let's do a simple exactly what you said. So let's say that you have $1, you win 30%, you're up $1.30. On the next trade, you lose 25%. I'm sorry, you lose
25%. 25% of $1.30. Go ahead.
And it takes you to 97.5.
Yeah.
Okay. So the thing is that you
which is under where you started.
Correct. You started with $1, and so you're losing 2.5% in the long run. And so you're going, well, I thought I had a positive edge. Well, that you sort of do. It's again, you've got this probability of all the money in the world, but no chance of ever making it. But when you get these errors that compound, you're destined for losses. And this is why one of the reasons I tell traders that you have to be super careful about saying, I want to just pick up 20, 30%, and I'm going to limit my losses to 10 or 15%, and therefore I'm going to be riding off into the sunset. I doubt it. My guess is you're going to have this compounding error coming after you.
The edge is not constant, right? The assumption is the edge is constant, but if you have a string of losses, and your account draws down to a point where now if you had a $100,000 account, it draws down. The 50-50 win-loss ratio isn't working in a moment in time.
And that's a whole separate argument, but a fabulous, fabulous comment. Yeah, this is assuming that it's just a coin flip, that it's just going on and on, which is probably not going to happen. Maybe you run through COVID or the crash of 07, 08, financial crisis. It's going to be a different ballgame. So now, next question, because on a related topic, we hear another group of traders who will say, oh, what I like to do is to sell these super far out of the money options for 30 or 40 cents. I'm going to put them on 10, 20, 30 times, whatever, and I'm getting this free money. Pricing model says there's no chance of it getting hit, and there's no vega to it. I'm not going to have any exposure to volatility. And look at the percentages that I'm making. I only have to post a couple of grand in margin, and yet I'm picking up a couple of $1,000.
Bill, there's no chance the model can lie to you, can it?
Well, that's a good question. The model is accurate under its assumptions. It's assuming that the only thing that changes is that it's a constant volatility. It is not accounting because it can't account for news. It's not a crystal ball, right? It's not the Black-Scholes crystal ball model. It is just saying if we have constant volatility, which is doubtful even over a 30-day period, and that
even a day-to-day period.
Even a day-to-day. Yep. And so if the volatility stays the same and the only thing that affects a stock's price is volatility, not news, this is where the stock can drift up and down to. These are the ranges. It's absolutely correct. But that's not really the way the real world works. So first question here, Scotty, let's throw it back over to you. Does an out-of-the-money option need to go in the money to become a risk? Because this is the big argument that I hear when people say, I want to sell out-of-the-money options because there's virtually no chance of it becoming in the money.
Not at all. You can see an out-of-the-money option lose value. It will lose value immediately as a stock moves. It doesn't have to go in the money.
Correct. Yep. We get changes in volatility.
You buy an 80-cent option and the stock moves in the opposite direction. You can see the option go to 20 cents. So out-of-the-money options may be attractive because they're cheap, but they can also lose value tremendously and quickly and sharply.
And don't forget, there's always the other side of that trade as well. That 80-cent option can go to $2. It doesn't go to $2 only, I think this is where you're going, Bill, only on a stock move.
Yes.
And well, this is assuming that the risk at expiration is different than risk prior to expiration. And so
wait, can you say that again, Scott?
Yeah, the risk at expiration is different than the risk prior to expiration. This slide makes the assumption that the option has to go in the money to take a loss. Well, if you're selling out of the money options, you're selling out of the money options, and the stock moves in the opposite direction. You know, the perception is eventually the stock will stay away from your strike, and you'll eventually profit. But your broker could margin you out of a short out of the money option very quickly, especially if the stock's moving fast. And if your tendency with those cheap options is to sell a large number, you have a very vast position, you could be margined out based on the maintenance margin, and you have no choice. So your risk at expiration is very different than your risk prior to expiration. And that's what Stu was saying that earlier. It's important to define your risk and understand it very well.
Yep. All good points. And that's really where I was going. For all of the Q&A people, they'll know this about normalized Vega, but take a look at this. Here's some assumptions. $200 stock. We've got the 175 strike, volatility at 30%. Now, over on the right, the put option is worth about 40 cents.
Sold.
And as
Wait
Scotty
a minute. If I sell 5, that's $200. I want to make $2,000. So
correct.
Now how many do I have to sell?
Right. Now you got to start stepping up with 20 contracts or 30 or 40. And that's what people do. And they'll say, oh, well, there's only a 5 delta. There's only a 5% chance that this is going to go in the money, which is wrong. But that's the way they'll look at it and say, oh, I'm willing to take that bet. But here's the thing. If you have an at-the-money option and you double volatility, this option would go to 80 cents. But let's try it. We're going to double volatility 2 times to 60%. Look what happened. It didn't double. It went up tenfold because it's an out-of-the-money option. Yeah, the Vega is very low, but relative to that initial options price, it's off the charts.
And check out the delta. Look at the delta change.
Yeah, you got
as
delta.
well.
I know, 5 to 20.
Can you go back a slide? 5 delta. Now go forward. Holy, you know what?
Yep, gone up to 20 delta.
Holy delta, Batman.
And as Scotty said, this is where the broker's probably not even going to give you a phone call. They're just going to start closing you out. But watch this. What if we push the stock towards the money, the money, without making it go in? Let's make the stock fall 10%. Not a big drop. Not that we haven't seen that lately. Right, Nike, I think, just popped up 10% the other day. But 10% move is not really unheard of. So if we get this with the 60% vol, which is probably why the vol popped, now look what happened. Now it's 24-fold. And
Ouch.
you're sitting here with the short 30 contracts. And now we go, well, I don't have the cash to buy the stock, and now I'm just going to take this big monster loss. And that's because people don't understand these nuances with the options.
You just dropped $935 on one contract.
Oh, yeah. Yeah, that can take you into 6-figure losses quickly. When I worked on Active Trader, I saw a number of accounts go negative equity to the tune of 6 figures from doing stuff like this.
Yeah, so was that my account?
No, it was not.
Okay.
For anyone who'd like to learn more, again, geteducatedmarketrebellion.com/get started. Okay, so let's wrap this up. For Chalk Talk, here was our question. I'm going to bring up my screen so I can see what you guys did. You get 2 choices. Let's say it's a spread. One is to pay 2 to make 8. The other is pay 8 to make 2. Which do you take and why? Stu, what did you choose? Takes numero dos. Scotty. I can't see.
That's a 2.
There
he is. I
don't
get that. Who's paying 8 to make 2? What?
Yep. And the point is, most people, I would guess, would say, I want to pay 2 to make 8. Why? Because it's a better percentage return. And they say, I have less risk. And that's really a misperception. You have a lower cost, but the reason the market is pricing this spread lower is because it's out of the money. That's why you're getting the very big reward. And this is also why you're probably going to end up in losses. If you're paying 8 to make 2, that's roughly speaking about an 80% chance of probability. Both of those options are in the money. Or if it's a credit spread, let's say with the puts, they're both out of the money.
Or calls.
It's a very, very high probability of making the money. So,
and Bill, I wish you gave us more choices there. We only had 2 choices, so we had these kind of extreme choices.
Extremes.
We want to trade to moderation, but that's a good point. You know, we want to
Bill, I think
not shoot for home runs entirely.
Away from the extremes.
Mm-hmm. the main point that I was trying to show, I mean, yeah, I know there's all kinds of arguments we could make about this, but I'm just trying to get people to think, not to argue about whether it was a perfectly valid question. It's to say, in the light of not having any other information, which would you choose? Most people would want to pay 2 to make 8, again, because they say, I've got low risk, not true, and I've got a very high percentage return. But the reason you're getting the high percentage return is because you've got a big fat monster risk that you're just not going to overcome. But the reason the market is willing to bid this price to 8 and only make 2 is because it's very high probability. Think of it like with T-bills. Why would people pay $995,000 for a T-bill that matures to $1 million. You shouldn't say, oh, that's a horrible risk-reward ratio. It's guaranteed. That's why the market pushes those so high and leaves the reward so low. And the same thing can happen here. So those are some of the things that I know that both of you do such a great job of working with your clients and showing them different ways based on a goal of attaining that goal by managing the risk and giving them a relatively high probability for success.
We talk about things like distance, like time, how these things affect
absolutely
the probability function of these different payouts.
Absolutely.
And also, Stu, finding a strategy that fits the trader's personality. You know, it's human nature to seek a high reward, you know, shoot for home runs. That's a human tendency. And a big part of trading is overcoming our psychological biases and finding strategies in a way to fit our own personality and finding a moderation of risk and reward and knowing how to define that through different strategies like spreads, diagonals, verticals, and finding the right securities to trade options on also is a very, very big part of the discussion as well.
And Scott, I know there was an expression you used to say, I've heard you say it about and I forgot how you worded it, with the risk, the decision to
stay in a trade is equal to that of getting in a new trade. A big fallacy or a big hurdle that every trader faces is not taking a loss. We stay in a trade too long, but staying in a trade is the same as opening a new trade.
Yes, it is.
So you ask yourself, would you enter that trade today? And if the answer is no, then you shouldn't stay in that trade.
Whether it's
our human nature tells us stay in the trade because I want this loss to turn into a gain or hold on way too long.
Yep. Mm-hmm. Lots of psychological traps. And those are things I know that both of you and Elliot, all of our coaching staff, does such a fabulous job of helping traders get through these volatile markets. So I think that's probably a pretty good stopping time. I know the three of us could go on all day long, but I hope that everybody out there learns something, gives you some more tips. And if you're looking for a coach to take your trading to the next level, please visit marketrebellion.com/get started. And that's all we have. And we will look for you next Thursday, same time. We'll see you then.
Thanks for having me, Bill.
Thanks so much, Scotty, for making it.
Yeah. Scotty, you're a smart guy. Where did we find you?
I know.
Well, you've been looking for a long time. I'm glad you found me.
Okay. See you, everybody.